Yeah.
How I find this fascinating because as an academic economist, it's very there's some differences between the economist might get at a bank who tends to be a bit more short term, to have a different perspective quite naturally. From where your vantage point is, and you look at some of the interesting dynamics in global financial markets at the moment. I'm talking about what's happening with the Bank of England, deteriorating financial conditions in the United States, a strong US dollar. You can sort of build a list out. Again, as an academic, what do you sort of get a sense as to what's going on here and what potentially worries you about what these little signals may mean?
Yeah, so big question, but let me one of my main worries about what's happening in the market right now, which can somehow be improved upon. It's easy to say from here, but is the fact that there is a disconnect sometimes between the real economy and the financial economy, which is a bit unhealthy. Like when unemployment rates are going down and labor market is doing well, the financial market panics and drops by a substantial amount last week, right? And that's the good news in Main Street is bad news for Wall Street. And to some extent that's always true because you increase interest rates, it'll affect and so these two things cancel each other out. But when it becomes a large move like this, we sort of have to ask ourselves, why is that happening? Why are financial markets not happy about the real economy doing well? And I feel some of it has to do with uncertainty related to policy, related to how interest rates are decided, and trying to read too much into the direction of monetary policy. And it should be a boring thing. Like we should just know, okay, this is what savings are doing, this is what lenders are doing, and interest rates should be about so much percent. But we have to think about what central bankers are thinking, what they're going to do, and every word that the Fed says or every word that Lowe says is analyzed so much that instead of asset managers thinking about, okay, which is the good firm to invest in, they spend so much energy trying to think about what the Fed is going to do or what Powell is going to, what RBA is going to do. And I think that is unhealthy. And I think that's causing a risk premium in financial markets that can cause the opposite. It can cause a panic. So in the past, it's caused a positive effect. Asset prices went up a lot because they were helping the economy. During the pandemic, we had such a great financial sort of outcomes, right? Though the real outcomes would not have been that as good, but the financial outcomes were quite good. And now we're having a bit of the opposite, where the good real outcomes are translating a bit into bad financial outcomes. And part of it, I believe, is just this uncertainty about what policymakers are going to do, which is driving prices down. So I think that part is unhealthy, and that we should do something about. And I think that's sort of across the board of UK, the US, and Australia. These sort of dynamics are playing out.
So is that to sort of make a point that we're over financialized in the global economy?
I think what I was trying to say earlier is we're making the central bank too qualitative. It should just be something that asset managers can predict to a large extent and not be subject to too much of what is the third word that was used by the central bank in their.
Yeah, certainly. One final question, I only say it because I was writing about it today, and it's made headlines in the financial world in the last 24 to 48 hours, is the Nobel Prize handed to Ben Bernanke for his work. Now obviously it's highly nuanced and it's very particular what he received the prize for, but there's the argument that perhaps the outsized role, or the very large role that central banks now play in economic management sort of started or accelerated through that period, especially with quantitative easing. We're seeing that tightening now coming through, that's causing issues. Is that a part of the same problem as well?
I think so. I mean, to be fair, he spent his entire academic career studying the problem for what caused the Great Depression, and one of his thesis was that it was because central banks didn't do enough. If they had supported the economy, there was mispricing in the market that could have been corrected, and some of the depression could have been avoided, and all the bad consequences of the depression, right? And I mean, it's great he got the Nobel Prize for that, but I think we have to think about the opposite problem as well. 50 years down the line, somebody might write a thesis that says we intervene too much in the market, and so otherwise a recession could have been avoided, right? So there's sort of a right amount of intervention, and not all interventions are the same. And to give you an example, I think in TARP, we ended up with intervening in the markets, but the US government made a profit on that. So when the prices went too low, they bought and they sold at a higher rate. So that sort of indicates mispricing that the central bank and policymakers corrected. But if we are trying to go against falling asset prices of whatever sector, and we're making a profit, so some central banks, I think RBA is negative equity right now, right? Then it's not clear you're actually correcting a mispricing, or are you sort of just going against where market wants the prices to be. And I think that nuance of when they should intervene and when they should not is something that we will study in the future.
And would a present example of that being the unfolding situation with the Bank of England as they try to stabilise the market without obviously causing this moral hazard?
Yes. And I think moral hazard, you've used the key word. I think part of the problem with too much intervention is too much risk-taking. Too much risk-taking means when you raise interest rates, there's too much distress. So you should look ahead and try not to do that, try not to introduce the moral hazard problem. And I think in the UK, they're double the problem. It's not just the central bank, it's also the government sort of reducing taxes. And the time when reducing taxes is probably good, but at least right now, the market doesn't seem to think it was a good idea for the UK. But that's a fiscal policy discussion, which
for another day,
for another
perhaps.
day, yeah.
Absolutely. Well, yeah, we have actually run out of time. But Konnach Saxena, Associate Professor at UNSW Business School, thank you so much for joining us.
Thank you for having me. It was a pleasure.